Yes, hello guys. Good morning, good afternoon, good evening, depending on where you are. My name is CPA Makan. Today I would like to take you through the leasing process, that is IAS 17. Want to understand what is leasing, types of leasing, how to recognize and measure the leasing in our financial statements as accountants when we are preparing the final accounts of that particular entity. First and foremost is to understand what is leasing. When you talk about a leasing, you are just referring to a contract between two people. That is the leaser and the leasee. So the leaser is the owner of the asset, while the leasee is the user of the asset. In this case, the leasee doesn't have money to buy the asset. So therefore, this particular leasee is now looking for an asset that can be entered into a contract so that he or she is able to use the asset to generate what? To generate or to produce goods and services. As this particular person uses this particular asset, he or she will be paying some amount to the owner. That amount paid to the owner is what you call rental payments. On this note, you are all supposed to pay the rental payments over a certain period of time. If that period of time lapses, you can either receive the title from the owner, or the owner can come and take away the asset. So it depends on how the contract was. Is it that by the end of the period, the asset will be transferred to the owner, or by the end of the period, the title will be transferred to the leasee? So therefore, in this case, we can now say lease is a contract between the leaser, where leaser conveys rights in the form of risks and rewards to the leasee in an exchange of receiving a rental payment over a certain period of time. So in this case now we are seeing two parties, leaser and leasee. In this case, one is giving out the asset, another one is using the asset. Now under this IAS 17, there are two main types of leases that come out. The first one is what they call finance lease. Finance lease. Finance lease is where all substantial risks and rights have been transferred to the leasee. Very important. All substantial risks and rewards have been what? Have been transferred. So risks here, we are talking about the maintenance cost of that particular asset. It can also mean the losses that can accrue when that particular asset is being used. It can also mean the depreciation of that particular asset as you continue using. When you talk about rewards here, we are talking about profits or any other benefit that we can get from this particular asset. So when the risks and rewards have been transferred, substantially transferred, or all amount of it have been transferred to the leasee, then we call that as what? Finance lease. Number two is what we call operating lease. Operating lease. This is a contract where not all the substantial risks and rewards have been transferred to the leasee. And it means then that by the end of the term, the title may transfer. Title may be transferred to the leasee. Therefore, this particular lease is very common, and all the time it is very common in most of the cases. But for this one, it is hard because when you go to all the buildings what we have here, not all risks and rewards have been transferred to the tenant. Because the tenant is able to either to do renovation, can maybe modify the building. If the tenant is able to modify the building, do the renovation, then it means that all the risks and rewards were transferred to that tenant. But if tenant is not allowed to do any of those, it will fall under lease. We have also a very common term here called, another term is what we call lease, minimum lease payment. Minimum lease payment. When we talk about a minimum lease payment, we are talking about payment over lease term. This is the payment This is actually the payment over lease term. This payment over lease term is what we are calling rental payment. Rental payment. Number 4, another term that is, although I'm saying these two are the types of leases, but I'm explaining also some of the terms that are very common in exams. Another term is what we call guaranteed. Guaranteed residual value. Guaranteed here means that this is a sum assured that by the end of that lease term, the leaser is able to enjoy. Either the lessee is able to dispose that asset or sell that particular asset, and any amount that amount collected from that particular asset at the end of the lease period will be transferred to the lessor. That amount that is guaranteed to the lessor by the lessee is what we call guaranteed residual value. Another term that is also very common is what we call unguaranteed residual value. This is the amount of money, or this is the value, this is the amount that that particular asset at the end of the lease term is not guaranteed to the lessor. If it will be found, that is the time the lessor can get. But if that money is not there, maybe the asset has depreciated to 0, then automatically it means that the lessor will not be able to get that particular asset. So therefore it means that by the end of the lease term, we can either have some amount remaining on that particular asset or none of the asset. The second one, is the fifth one, the fifth term is what we call interest rate. Interest rate implicit. Now, interest rate implicit is the same as discount rate. Discount rate. This is a rate in which we are using, to discount all the minimum lease payment to present value. So this is a rate that is mainly used to discount the minimum lease payment to present value. So that case, it means that if, for example, the minimum lease payment, this is actually the future economic benefits that are flowing to the organization. We have to discount this to present value. The rate that you will be using to discount this minimum lease payment to present value is what they call interest rate implicit. In financial management, we are calling this one cost of capital. Sometimes we call it rate of return. So therefore, if you are doing financial management, you must have come across cost of capital or rate of return. But in financial reporting, we are calling it interest rate of implicit. Interest rate implicit. Now, this rate also can be used to discount unguaranteed residual value. You can see that this amount of money that is being probed or expected to be at the end of the period need also to be discounted to the present value. So if you discount these two, you will get what you call the present what? Value. And the summation of these two, if you try to add these figures here, it must be equals to the fair value of the asset. Equals to fair value of the asset. So therefore, this is how it is done. That if, for example, you have the minimum lease payment, present value yake is about maybe say 8,000 for 800,000. Then we have also the unguaranteed value of maybe 60,000. So when I add these 860,000, it should be equals to the fair value of the asset, which is 680,000 also. And I've said that fair value means the market price of that particular asset when it is about to be sold or bought in the market. Now, let's now go and do what we call accounting for operating lease. Accounting for operating lease. Now, we have said there are two types of leases. Operating lease where not all the substantial risks and rewards have been transferred to the third party. That is the lessee. Now, on this note, how do we account this? This is very simple. In the books of the lessee, these rental payments here, rental payments should be recorded as expenses. Sorry, not assets, but as expenses in the P and L. Simple. That if you are the lessee, any payment you make on a periodic basis, you record them in the P and L account. You get the point now? Now, on the same note, sometimes you might be told by the lessor that because you have just entered into this house or you have just taken this land on a lease, instead of you paying immediately, let me give you 1 month holiday. That 1 month holiday in this particular topic is what is called incentive. The question now is, how do we recognize incentives in the financial statement? According to this IAS 17, these incentives are supposed to be spread over the lease period. Very important point. That if there is any incentive given, maybe you have been told you will take a holiday of 2 months or 3 months not paying, how do we account that in the books of accounts? It is not free. You have to know how to account. Here we are being told that you can only account that by spreading over the lease payment. For example, e.g., assuming that you have been told out of the 20,000 is the periodic payment per period. Now, for the first one period, you have been granted this particular holiday. You will not pay this, but you will pay this 20 the second month, second period. How do we account this? First of all, go to the lease contract. If the lease contract says that particular asset will be leased for 5 periods or 5 years, you have to spread this 20,000 over 5 years. So therefore, it means that you will take 20,000, you divide by 5. You get, your figure is 4,000 per year. So therefore, it means that you can now say we have year 1, 2, 3, and 4. If the period is 20,000, in year 1 you will not pay, it will be 0. But in year 2 you will pay now not 20,000, it will be now less 4,000. So you will pay 16,000. Here is also 16,000, and here is also 16,000, and the fifth you pay 16,000. You can see how the incentive is treated when you have been asked to do so. So in most of the questions, you will find a question like that from the leases, and you are asked to find out how do we go about. Next part is how do we account leases, finance lease. How do we account finance lease? How do we account finance lease? So accounting for finance lease. Very important. Finance lease is where you have transferred the entire risks and rewards to the lessee. And because you have transferred all this, it means that you don't have that particular asset with you completely. You don't have that particular asset with you. Therefore, it means that the asset has left your premise or your hands, and it is now in the hands of another person. Therefore, it will be very wrong for you to continue recording that asset in your books of accounts as non-current asset, because you don't have that asset. That asset is not there. So therefore, it will be wrong for the lessor to continue recording that asset into the books of accounts. But what that lessor should do is should record what they call receivables. Instead of now that property, the lessor should have what they call rent receivables. Why? Because this particular asset will be generating rental what? Payments. So the lessor should have this element here called rental receivable. So that when the lessee pays money, the money will be debited into the bank or cash. Okay? Then should be credited from the rental what? Rental receivables. So therefore, when you are dealing with the finance lease, we are supposed to ensure that we create rental receivable, but not the asset. The asset is not there. The asset left that particular premise and is in another premise or with another person. So you should not bring that particular element. Now, another point is what you call land and building. In most cases, leasing deal with the land and buildings. So in this case, according to IAS 17, these particular two elements need to be separated. You cannot treat them at the same time. You cannot consolidate them and say the fair value of land and fair value of the building is this. Then you put all of them at once. It will be wrong. For the sake of leasing, or for the sake of lease contract, you are supposed to separate the two. Why? Because either of the two can be a finance lease or an operating lease. And therefore I'm saying if it is a finance lease, it should not appear in the books of accounts of the leaser. Now on this note, the reason why we are separating this is because land, in most cases, land is always treated as operating lease. Why? Why? Because this land has indefinite term, which means it doesn't have the end. So the land will not depreciate to zero. It will always be appreciating all the time. So the land will stay many years and many years and many years, many generations to many generations. And because of that, anyone who is possessing the land is just on operating lease. That is very important point. Number two, land can also be an operating lease. Yes, that is point number two. What about the building? What about the building? The building is always classified under finance lease. Why? Because building has definite period, definite term. In simple terms, it has lifespan. Buildings don't stay for many years. Buildings always keep on depreciating until it is zero. Therefore, it means that buildings cannot be classified under operating because it has a definite period. It has economic life. That once that economic life reaches, automatically it means the building will be zero. Therefore, it will be classified under what? Or finance lease. That is only for substantial risks and works have been transferred. Now, on the same note, there are also some circumstances under which land can be classified under finance lease. That is why I want to be very careful. What are the circumstances that will lead to land classified under finance lease? 1.1 on this area, the land can be classified under finance lease if minimum lease payment is more than what? 90%. If the minimum lease payment will be more than 90%, that is the time we say that particular land can be classified under what? Finance lease. So therefore, it is very important for us to note that this land can be treated as a finance lease if it meets the existing criterion, specifically if the risks and rewards of ownership can be considered to have been what? Transferred. Now, in this case now, another point on that particular area is that if the risks and rewards have been transferred. If you see that risks and rewards have been transferred, that is the time now we'll put under what? Finance lease. That is very, very important. Now, let's see an example of land and building that is given together to clarify or to explain the difference. look at what is going to happen here. If you don't have these notes, kindly you can reach me on 0735 346 777. I'll be able to give out the notes on leases. So reach out to that and I'll be able to give out. So let me read the question to explain how land and building can be treated in the books of accounts. The question reads, a business has taken out a new lease on a factory building and surrounding land. The fair value of the building is 5 million and the fair value of the land is 3 million. The lease is for 20 years, which is the expected life of the factory, with annual payments in arrears of 500,000. The business has a cost of capital of 8%. The annuity factor for one receivable every year for 20 years is 9.818%. So required, categorize land and building on either finance lease or operating lease. Solution. First of all, for us to separate the two, we have to use what we call fair value. Fair what? Value. So the fair value is the market price. So we are supposed to use the fair value of the market price to separate the rental payments paid for land and building. So let's see example here. We have been told from the question that a business has taken out a new lease on a factory building and the surrounding land. The fair value of the building is, so we have the building, the fair value of the building is equals to 5 million. And the fair value of the land is 3 million. Land, 3 million. That is the fair value of the two elements combined together. The lease is for 20 years. So this particular business has leased the asset for 20 years, which is the expected life of the factory, with an annual payments in arrears of 500 what? 1,000. So annual payments, that is rental payment. There is now the rental payment. The question, this rental payment we have been given is 0.5 million or 500,000. How do we want now to separate? The rule here is that you have to separate the value of the rental payment for the land and rental payment for building. How do we separate the two? Here we have been told the only method you can use is the fair value. Use the fair value method. Very important. Therefore, it means that don't use the cost of the building and don't use the cost of the land. Use the fair value, which means the market price of the assets. So therefore, for me to apportion this one, I will just do this very simple. Building is equals to, I will take the value of the building, 5 over the total. Total is now 808 there, times 0.5. Then for the land, I will take now 3 over 8 times 0.5. So when you do calculation very well, you will find that the land will give you 100, this is millions, 187,500. And for the building, it will give you 312,500. So that when you add the two, it will give you a 500 what? 1,000. What have you done? You have apportioned. And you have now said the building will go to this. And remember, the concept here is land is always classified as operating lease, while the building is always classified as finance lease. But we want to prove that, whether it is correct or not. Now, in this case now, get this one and this one are a rental. So convert the rental into, convert rental payments into present value. Now, for the land, for the building, we have been told that the rental payment is 312,500. 312,500. We have already been given the discounting factor. Remember, it has already been done. In financial management, you normally say that discounting factor is given by annuity, is given by 1 minus 1 plus r power negative n. You divide by r. You work out what is on the numerator first, then you divide by r. Automatically, you get the figure given in the question of 9.818, meaning that This is how it has been done. 1 minus 1.08, then power negative 20, you divide by 0.08. So if you work out this, you will get 9.818 like that. So you'll get this discounting factor. Now, this discounting factor, we need to discount this cash flow. So you multiply by 9.818, you get the figure. For the land, it will be 187,500. You multiply by 9.818, you get the answer. Now on this note now, you'll be able to find the figures for this will be how much. If you use your calculator very well, how much do you get? For the land, you will get 1,840,000. That is for the land. Then for the building will be the difference now. The building now will be the building will be 312,500 multiplied by 9.818. So your answer is 3,068,125. You've add all what you get plus 1,840,000. So you are getting 4,908,125. You can see that. Now, we can now find out, you see this land here, we can see if, how we want to find out whether this land is operating lease or not. So for us to do that, I will take 1,840,000, you divide by the total, 4,908,125 times what? 100%. So we talked about 90%. So take 140,000, you divide by 4,908,125. So your answer there is 37%. So because it has fallen below 35, if it will be more than 90%, that is the time the land will be classified under what? Finance, operating, lease. But now the way, because it is below that, we can now say the land is under finance, lease. If it will be less than 90%, it will be classified under finance what? Lease. That is how you are supposed to work on that particular area. Yes, we are moving well. We are moving well, so let's move on. So I hope yes, so we are moving on well. So let's see now the apportionment of a subtopic is apportionment of rental payments. Apportionment of rental payments. These rental payments that we are paying, we need to do apportionment. That is to say, you want to differentiate the rental, we have to differentiate the interest that we are being charged on the same from the capital cost. So we have to differentiate now the interest charge and a capital cost. So when you talk about a capital cost, remember when it comes to leases, if you are not able to pay the entire amount of money, what will happen there is that you will go with it's like a loan. So this lease is treated like a loan. Because you don't have the entire amount of money and you need that particular asset, the balancing figure will be taken as a loan. So therefore, that loan is what you call a capital cost. But now the interest cost here is the benefit to that particular leaser. So therefore, for us we need to differentiate the two. That is what we call apportionment of rental. In this case, there are two methods that we have been told. Method number one is what we call actuarial method. Actuarial method. So these are method. Another one is what you call sum digit method. These are two methods used to differentiate or to apportion the rental payment. So therefore, actuarial method, you just take the percentage of interest, you multiply by the balance. You multiply by the balance. So if you take the interest in which that particular lease will be generating, you multiply by the balance. That is the time you get the actuarial. You are using the actuarial what method. But for the sum digit method, you just to take, if they are saying the lease is for 5 years, you just say 1 plus 5, 2 plus 3 plus 4 plus 5. This gives you what? 15. So in this case, it means that for year 1, you take for year 1, for example, period 1, 2, 3, 4. For year 1, it will be 14 over 15 times the rental payment. This one will be 13 over 15 times the rental payment. This one will be 12 over 15 times the rental payment. This one is 11 over 15 times the rental payment. If you are doing like that, you'll be able to separate or to apportion the elements into that. So let's see an example. Let's see an example to see how this one. Now, before we go to example, the common method that is mainly tested and advised to be used is actuarial method. The sum of the digit method has an error. This is very accurate because it is giving you an interest multiplied by the balance. But this one here, it is not recommended. And in all the syllabus, CASNEP and ACCA, actuarial method is the one that is required to be used in calculation. Let's see an example. There's an example there. So I'm still saying, if you like the notes for leasing, kindly reach me. Then you will get these notes plus the questions. My number is 0735346777. The question says, on 1st January 20X0, Bacchus Company, wine merchants, buys a small bottling and labeling machine from Silena's company under finance lease. The cash price of the machine was $7,710, while the amount to be paid was $10,000. The agreement required the immediate payment of $2,000 deposit, with the balance being settled in 4-year annual installments commencing on 31st December 20X0. The charge of $2,290 represents interest of 15% per annum, calculated on the remaining balance of the liability during each accounting period. Depreciation on the plant is to be provided for at the rate of 20% per annum on the straight line basis, assuming residual value is nil. So here we have been given the cash price, so extract information carefully. Here we have been given the cash price of 7,710, correct? We have also been told there is an immediate payment, deposit. Is done immediately of how much? 2,000. We have also been told that there is, by the end of the period, it should be 10,000. That is to say, 2,000 is paid immediately, then the remaining 8,000 will be paid after you have signed the contract. Now on this note, you pay this one. Then from there, you have also been told there is the installment of how much? Installment there you have been told of the same amount, that is 2,000. Then you have been told this one should commence on 31st of December 20X0. The charge for this 2,290, that charge is inclusive interest and the capital cost, as what we have just said here. These two. The 2,290 is made up of, that 2,290 is made up of that. Then there is an interest of how much? 15%. Then there is also the depreciation rate of how much? 20%. Now, solution. We are using actuarial method. Here we are saying balance. How do I get the balance? The cash price is 7,710. You have been told I have to pay immediately 2,000. So you subtract 2,000. So your answer is 5,710. 10. This is now the balance. This balance in the lease is treated as a loan. Okay? And this balance here is the one that will attract an interest at the rate of 15%. Now for this case, it will be very simple now. Now we can now say balance. Let me now see how I'm doing it. Balance from 1st of January 20x0. The balance now is 5,710. That is the balance at the beginning of the year after paying my 2,000. From here, I will now have an interest of 15% of this. 15% of that, if you press your calculator, it will give you 856. That is now, this is for the whole year. Then we have now installment. Installment, when is the installment paid? Installment is paid always on 31st of December 20x0. That is, we are dealing with the first year. So even this one is by the end of the year. So this is 2,000. If you subtract that one, your answer you will get is the balance carried forward of how much? You will get 4,566. This is the balance carried forward as at the 31st of December 20x0. So we now say, let us have an interest now during the year of 15% of that. You will get something to do with the 685. Then we have installments. By the end of the year, that is 31st of December 20x, which 20x what? 1. And this also 20x1. So this one is 2,000. So subtract. So your balance carried forward as at the 31st of December 20x1 is how much? That is 3,250 or 51, sorry, 51. Then from here you generate an interest at the rate of 15%. That will give you 488. Then we have now the installment, for that matter, 2,000. Okay? Installment of 2,000. So for that case, you will get now 1,739 as what? Balance carried forward as at the 31st of December 20x2. 20x2. Then you go to interest. Still 15% of this. You get 261. Then we have the installment of how much? 2,000. So if you subtract, you automatically get 0. You automatically get what? 0. So we have how many years? 20x0, 1, 20x1, 2, 20x2, 3. So there are 3 years consecutive. Now, that is very important. But the question here is, if it is an exam, can you do all this? No. Here it is the reason why. Now, when a question like that, when a question of leases is given in the published financial statement, you are not supposed to do all this. Assuming that you are preparing the books to 31st of December 20x0. How do we calculate leases? And remember, how do you calculate leases here? The rule here is, when you are preparing the books to 31st of December 20x0, you have to proceed with this table here to 20x1. That is the rule. Why? When you proceed now to 20x1, you will be able to tell how much will go to non-current liabilities and which one will go to current liabilities. So if you don't go beyond one extra period, you will not be able to differentiate the two. So the only way you can differentiate the two is to ensure you add one period. For instance, for this case, there are 3 years. So I don't need all this when it comes to preparation of financial statements. If it is for 20x0, I will go to 20x1. Therefore, this is how it is. 20x1, where is the end of 20x1? 20x1, where is the end? 20x, this is 20x. So 20x1, this is 20x0, this is 0, and this is x1. So so this amount here, this one you are seeing at the end of 20x1 is non-current liability of 3,251. Meaning that you are in your statement of financial position, non-current liabilities, other than the loans, other than deferred tax, you will put this as lease. Non-current liabilities, lease this amount. How do I get then the current liability? It will be very simple. You just now take 20x0 minus 20x1. So this one will be 4566 minus 3251. So your value there will be, how much is that? How much is that if you subtract class? So if you subtract, the figure you'll get is for the current what? Liability. What about in the income statement? Which figure will go to the income statement? The question here is, income statement, you are dealing for the period 20x0. So your income statement will take 800, and so in the income statement, the interest there, or you call it finance cost will be 856. So you can see, statement of financial position, two elements, non-current liabilities, which means that non-current liability is very simple to see. If it is 20x0, give one extra table, which gives you this. Now, if it is current liability, you have to take now the period you are dealing with minus the period that you have gone, and you'll be able to get this particular element. Now, how do I get the interest in the income statement? It is automatically in the year that you are focusing. That is 20x0. I hope that is clear. Yes, so we can move on. How do we disclose these disclosures? We have seen apportionment, that we have to apportion, and you can see apportionment. We have seen the non-current liabilities and current liabilities lease. So how do we ensure that we disclose this? How do we disclose? When we talk about disclosures, we are talking about how do we show these figures in the financial statements. So we can now say lease disclosures. Lease disclosures. How do we show them in the financial what? Statement. Let's use the same question. How do we show? It is very simple. Number one, first of all, you have to know the name of the business. What is the name of the business? You put the name of the business, assuming it is ABC Limited. Then you say statement of financial position. In this case, it is not complete. Therefore, you can say extract. Correct? Extract. Now we have the non-current assets there. Non-current asset. At cost, we were told it is 7,710. This figure here is undergoing depreciation. So less depreciation. In this case, we are told it is 20% of the cost. 7,710. So what is that figure? You get 1540.42. If you subtract now, your figure is 61.68. So the net book value is that figure. Correct? Now what about now in the non-current liabilities? You come and say non-current liabilities. Non-current liabilities, we shall have now the lease. In this case, we had already the figure for the lease. You remember the figure we got? We found to be 3251. Then current liabilities, current liabilities. In this case, it will be 4566 minus 31, that's 251. So this figure will give you as 3115. So this is how you are supposed to show in the financial what? State proposition. So you can see I'm showing the asset here, the cost minus depreciation, I'm getting that. Then I go to non-current liabilities down there. I will have lease. Of course, we have also deferred tax, and we shall also be having loans, maybe if that. But here I'm dealing with the leases, so I will put the figure. Then for us current liabilities, I will put that case. Now, what about in the statement of financial income statement? So statement of profit and loss. Extract. Extract means it is not complete. Therefore, the only element that will go here is the interest for the year. We say finance lease, finance cost. It is now the interest. For which year? The first year that you have calculated. In this case, it was 856. So if you are told to give out the extract, that is how you are supposed to. That's how you're supposed to show. And this is what you call what? Is disclosures. Lease disclosures. Lease disclosures. Now, what we have been doing here is that we have been assuming that the interest rate is paid annually. What if the contract says it will be semi-annually? How do we go about? How do we go about if the question was saying semi-annually? Semi-annually means now in this case that the payments you are making is twice per year. So therefore you don't make it at the end of the period, but you make it what? Per year. So let's take for example, this is now leases, and then it's we call it semi-payments. Or semi-payments. You are making payments twice. So in this case, we are going to use the same example, but we are just going to change some few. Now let us see what would have changed if backers was not required to pay a deposit, but is not required to pay the deposit of 2,000. That means that the cost was 7,710. So you are not required to pay a deposit of 2,000, meaning the deposit is not there. So you are supposed now to make the payments as usual. So in this case, what will happen? But had to pay 1,250 every 6 months. That is what now? That is your installment. For 4 periods. For 4 periods. 4 periods meaning what? 4 periods? Correct. We will use the same interest rate and calculate the amounts for the first year. So we have been told, assume there is no deposit at the beginning of the year, meaning the balance remains 7,000. So we can now say, okay, balance on 1st of January 20x0 is, I want you to follow me carefully, 7,710. Why? I'm not using 5,710. Why? Because you have been told in this case, assume there was no deposit. So it will be like this. Then the interest now, interest in this case is semi-annually. So therefore it means that I will take the 8%, the 15% for the whole year, but I will multiply by 6/12. That is half of the year. So I will now say my interest here, when is the interest done? It is now 15% of 7,710, but half a year. That will give you how much? 578. That is an interest. Then installment, you have been told it will be 1,250, not 2,000 as it was in the previous example. So installment, in this case, installment is 2,000. Subtract. So when you subtract now, you will be dealing with, this installment is done at the end of the period. So therefore, you will have now the balance. Look at how they are saying, but had to pay 1,250 every 6 months. Very important. So from 1st of January for 6 months. So this now balance as at what? 30th June 20x0. So how much is that balance? I'm getting 7,000 and 38. Again, you come and introduce your interest there, which is 15% of that figure, 7038, but not all because it is half a year. So that will give you 528. Then we have also installments. Installments for, is it the whole year? No, 6 months. That is 12 what? 50. Subtract. So this one will be now the balance as at what? 31st December 20x 0. So this is the end of the year. I hope you are getting it right. This is the end of, this one is not the end of the year, this is just per period. So this will give you now 16. We begin, we now go to the second year. Now we go to interest. 15% of 6316 times 6 over 12. So your answer there is 474. Then we have installments. Installment in this case after 6 months is 1250. If you subtract what you get, 5540. What is that now? This is the balance as what? As balance as 30th June 20x1. We have not finished the year. Then we go to interest. Interest is still 15% of 5540 times 6 over 12. So what do you get there? 416. We have the installments there, which is 1250. Subtract, your answer you will get is 47060. So this is for which year? Balance as what? 31st of December 20x1. So this process can continue like that until the end. You can continue until the end. But now, I want us to stop here so that I'm able to demonstrate, correct, disclosures in the financial what? Statements. In this case, we are preparing the books for the period 31st of December 20x0. Because of that, I've given a reason that if you are preparing the books of books for the period 31st of December 20x0, you have to proceed to 20x1 so that you are able to know how much will go to non-current liabilities and how much to go to non-current liabilities. In this case, our work will be very simple, very simple. Now, this figure here will be under non-current liabilities. See, this is non-current liabilities, this figure. What about current liabilities? What about current liabilities? Our current liability for the year, we have the 31st of December. You see this figure here? So I will take this figure minus this, not this figure minus, because this one is half a year. So therefore, current liabilities will be 6316 minus 4706. I will get my current what? Liabilities. Now, on this note, my work will be very simple. Now, I can say statement of financial position extract. Statement of financial position extract. So, I will now go to non-current assets, non-current assets. We were told it will be 7710 multiplied by, no, 7710 is the total minus the depreciation. In this case, it will be 20% of 7710. You get that? You get the net book value. Then we have now non-current liabilities. Non-current liabilities, these are leases. The figure is what? 4706. Then I go to current liabilities. I will pick the difference that I have here. You put that figure there. So when you take now, there is a remember you have to disclose. You have to disclose your. You have to disclose purely the net book value of the asset. So this is a cost minus depreciation, you will get the figure there. Now, for the statement of profit, statement of profit and loss extract, what are you going to show? What are you going to show, class? You are only going to show the interest for the year. Interest for the year, which year? 20x 0, which means this is for 6 months, then this is for the last 6 months. So therefore I will add the 2. I will now take 578 plus 528. Then I will get the figure there. Automatically, you would have now disclosed that information. So I hope you have enjoyed on how to treat financial leases in your financial statements when you are preparing published financial statement. So I'm going now to the last point on the leases. The last point on the leases, so that we don't forget. Okay? Last point on the leases. Now, what if the question contract is saying you have to pay advance payment? How is advance payment affecting your leases? Advance payment here means that before you sign any contract, you pay some amount, not a deposit. Deposit is purely affecting your balance brought down. But this one is saying advance payment. In this case, the interest you are generating should only come after you have removed advance payment. But the previous example that I've just finished here means that the interest is coming without any deduction. Look at how it is done. Assuming now this is advance payment. You have made things in advance. Things will be very simple. How do you calculate what? Interest. So advance payment will automatically affect the way we calculate our interest. So this is how it is done. Assuming the balance as it is 7,000 what? Okay, let me read the question here. Now, when payments under a finance lease are made in advance, the payment for the year will be made before an interest for the year has accrued on the capital balance. This affects the calculation of current and non-current liability. We can take the example of the backers again, and the payment are 2,000 in advance plus 2,000 deposit. 2,000 advance and 2,000 deposit. What does it mean? First and foremost, remove the deposit first. So it will be 7,710 minus the deposit first. Your answer now there is 5,710. Then, instead of now saying interest, this amount, you cannot do that because the payment, there is advance payment of 2,000 again. In this case, you now say you less advance. This one we call it now installment. Of how much? 2,000. Then you get now 3,710. So this 3,710 is the one that will attract the interest. Now you come and say your interest. Interest now is 15% of 3710. 15% of 37 what? 10. So it will give you 556. You see that? Then from there, that is 20x0. You get now the figure. Once you get the figure here, this is now will give you something to do the 4266. I want to explain something. The previous example, if there was no advance payment, we were saying, once we get this, we take interest here. This interest was here. Then this one was down here. But because there was advance payment as per the question, we are now subtracting first that advance, so that the remaining balance is now what we use now to attract what? Penalties. So that is how you are supposed to analyze this particular area. The question here is now, which one is non-current liability class? Non-current liability is this. Then current liability, So this is a current liability, this is non-current liability, and this one will be current liability. So the point here is, how do you treat advance payment? So advance payment will immediately affect the lease first before you bring in installment. So that one marks the end of the topic on leases. Therefore, I wish you well as you continue studying and going through the syllabus and going through the past papers as you can have. If you don't have the past papers, kindly reach me on 0735 346 777 and go through the questions on published financial statement. Published financial statement. Specifically on additional information, you will see the questions like this. One is maybe advance payment. Another one is not having advance payment. If they say advance payment, how do we treat interest? If there is no word advance payment, then it is the normal way. The balance you have plus times the interest rate, you get that, then you proceed. What is very important here, and I'm insisting, is how to separate the leases. The one to go to the non-controlling non-current liabilities and the one to go to the current liabilities. So if you have not understood, kindly reach me and have a blessed time. Bye.